What's up guys, welcome back to Might As Well. I hope you're all doing great, as today I got a really special video for you guys. In today's video we are going to analyze another tech company that has recently also been in some news, which is Intel. But let's not waste any time and get right into it. Intel is based in the US, or to be specific in California, and focuses on providing computing, networking, data storage and communication solutions worldwide. But let's at first have a brief look at the key financials that Intel has to bring to the table. As per usual, let's start out with the company's market cap, which currently sits at right about 206.4 billion US dollars, which obviously is already on the bigger side of the scale. But as you probably know, this valuation does not come out of thin air and can be attributed to a lot of different factors. However, one that in my opinion always attributes a ton to it is the revenue of the last fiscal year, which in this case sat at about 71.9 billion US dollars. This number on its own is pretty great, especially when it comes to the PE ratio which Intel is currently trading at. But more on that later on. For now, let's only break the revenue of Intel down a little bit further, in order to be able to understand what exactly makes the company money and to what extent. Generally speaking, Intel divides their revenue into 6 segments, but let's sort these from the biggest to the smallest. Coming in at first place, we have the client computing, with 37.1 billion. This is then followed by data center services with 23.5 billion. In the third place, we have the Internet of Things services with 4.7 billion. This is then followed by non-volatile memory solutions with 4.4 billion and programmable solutions with 1.9 billion. Last but not least, we still have the other income sources, which contribute another 289 million, obviously making up the smallest income source of the company. But enough with the introduction, which we now have knocked out of the way. Let's move on to something which you probably all want to know about, which are the distributions to shareholders. At the point of making this video, Intel currently rewards the trust of their shareholders through the most common distribution forms, which are dividends and stock buybacks. At first, let's focus on the dividend of Intel, which currently sits at $1.32, equaling a yield of about 2.71%. This is fairly decent, and in my opinion you can't speak a ton against that number, especially if you look at the fact that Intel has been growing its dividend consistently for 6 years. However, it must be said that the company has been paying a dividend since 1994, which makes the 6 years of growth somewhat less attractive. But enough with the raw information, let's actually have a look at the numbers behind the distributions. At first, we obviously want to build the basis for the sustainability of the company's distributions, which we do by having a look at the company's free cash flow. Generally speaking, if we look at the big picture, this goes up, but however has a minor bump in the year of 2017. This in itself isn't too bad, since we obviously want to have a look at the big picture to evaluate the distributions. If we now move on to the dividends, in this graph we can right from the bat see that these are constantly going up. Yet they still stay below the company's free cash flow in every year, and that by a pretty significant margin, which is a really great sign. But as I've previously told you, the dividends are obviously not the whole distributions, so we still have to add the amount spent on stock buybacks to them. If we now take a look at this graph, we can pretty much see a similar trend, which is a pretty constant increase of shareholder rewards. However, this time it actually somewhat surpasses the free cash flow in the years of 2018 and 2019. Although this is only by a pretty small amount, it still exceeds it, which overall is nothing too big to worry about if it just occurs in these 2 years at a small rate. However, should it occur more frequently, this means that the company has to take on debt in order to cover the distributions to shareholders. Now, let's directly, without any breaks, jump over to Intel's balance sheet and take a look at what financials they have to bring to the table. As always, let's start out with the year of 2015, in which Intel's total assets sat at about 101.4 billion US dollars. These were made up by about 38.3 billion in equity, 20 billion in long-term debt, 2.6 billion in current debt, and 40.5 billion in non-interest paying capital. In order to now actually understand these numbers and get real information out of them, as well as help us evaluate how good the balance sheet actually is, we will calculate the net debt of Intel. This is obviously done using the company's debt and its cash position. For the case of Intel in the year of 2015, we get the net debt position of $0. For now, we can set that value to the side and jump to the year of 2019. As you are all able to see, Intel's total assets increased, and that by a pretty significant amount, of about 35 billion to about 136.5 billion US dollars. These were now made up by about 31.2 billion in equity, 25.3 billion in long-term debt, 3.7 billion in current debt, and last but not least, a staggering 76.3 billion in non-interest paying capital. If we now again calculate the net debt for this year, we land at about 15.8 billion US dollars. As we already quickly see over our time frame, the net debt of Intel somewhat increased. But let's find out how sustainable the debt actually is. We do this using the EBITDA, which is the pre-tax, pre-interest, pre-depreciation, pre-amortization income of said company. For the case of Intel in the year of 2015, this set at 0. This means that Intel can basically clear out all of its debt with the cash it currently has on hand, which obviously is the ideal scenario. If we now do the same thing for the year of 2019, with Intel's net debt of about 15.8 billion and its EBITDA of about 32.8 billion, we get a sustainability ratio of 0.48 or 48%. This would mean that if Intel wanted to do so, they could pay off all the outstanding debts within half a year, which is also a pretty good time frame. However, you have to be aware that in order to be able to do this, they would have to stop paying out their distributions and focus their capital on paying off debt. Alright, after having all of the financials covered, we still want to take a closer look at the company, which will also influence our margin of safety later on. First of all, let me point out to you that Intel recently has had some bad news, as I would consider them. These are, for example, the delay of their newest chipset to 2022, which led to the share price dropping by about 20%, which is a very significant amount. This pretty much pointed out a problem with Intel that had been ongoing for a while now, and that is a lack of structure. While Intel has been the big market player for quite some time now, they've never really been able to completely dominate the market. This can somewhat be attributed to the fact that, due to the mentioned lack of structure, they never were really able to capitalize their advanced technology. Since now a ton of competitors have caught up to them, a failure like the recent one can be pretty deadly, forcing them to make place for a company like AMD. Therefore, I will add 10% to my margin of safety. In addition to that, I personally see another downside with Intel, which kind of bothers me personally. As you all know, I like to invest in dividend-paying companies, especially those that follow a constant and strict dividend policy. However, I somewhat have to say that with Intel this is pretty much all over the board. Sure, they constantly pay their dividend, and there is a ton of wiggle room for increases in the future. But in the past, the company has managed to do some weird things with its dividend. Don't get me wrong, I'm all for investing in a business, but if you have cash to spare, might as well increase your dividend, even if it's only by a slight amount. This is only a point that annoys me personally. However, I'm still gonna add 5% to my margin of safety for this exact reason. But it's not all bad things, as Intel is actually a really great company. Intel is still in a really great market position, and is actually taking a few very brave steps, one of them being a push into the data-driven market. While Intel has until now been mainly serving the computing market, this actually allows them to capitalize on what many consider the future. Therefore, I'm reducing the margin of safety by about 10%. The next point is actually somewhat directly tied to the previous one, and one of the downsides I presented before, and that would be that steps are being taken. Remember when I told you about the delay of the new chipset? Well, it had consequences. For example, the head of the technology division stepped down, making place for a whole new structure that is supposed to improve productivity. This offers us a first indicator that something is being done about the problems which have come up over the last few years. Since I'm fairly confident that this will really help the company in eliminating their biggest issues, I'm again going to reduce my margin of safety by another 10%. But what would I be willing to pay per share, and what is the fair price to pay? In order to get the fair value of the stock, we have to take a little look at the historic dividend yield. For the past 10 years, we had an average dividend yield of 2.9%. This obviously means that you want to buy the stock if the yield is above that average. This would mean with the current dividend of $1.32, the fair price to pay per share would be $45.51. If we now want to calculate the value I would be willing to pay for the stock, all we have to do is again get the average dividend yield of 2.9% and my safety margin of 20%. This gives us our target yield of 3.48%, which leaves us with a price to buy the company at of about $37.93. This was Might As Well. I hope you liked the video, and I'll see you in the next one.